started. That's enough of that stuff. Let's go on and get started to learn about candlesticks. Now, most new traders learn a little bit about candlestick analysis, but most of what they learn is completely useless. And I'm sorry, candlesticks are the first thing that everybody talks about. The minute you're a new trader, all you want to do is talk about candlesticks. Well, you've heard over the years about engulfing candles and haramis and dojis and all of these. These are called pattern recognition. But it really fails to work in real live trading situations. Can I see this formation with that formation? And am I going to do exactly that? You know, what they try to do is tell you when this appears, this is what you should be doing. Well, it doesn't work that way in real trading. First of all, it takes a lot of effort. And I've been trading for a very, very long time. I don't see and recognize most patterns on my charts. My charts are busy, they're active. I'm busy and I'm active. I don't have a time to see, oh, look at that. I have a doji and it's formed next to, you know, a harami. And therefore, what is that? Oh, that tells me to do. But don't misunderstand me. Knowing some of the major patterns is important, because you can't skip right to the advanced candlestick analysis without knowing some of the basics first. But if you don't know the basics, that's fine. I got you covered. So let's pop over to a live chart and show you how easy candlestick recognition is now, because computers have made the world an easy, easy place. Okay, now there are about 72 major candlestick patterns. Some are made up of one candle, some are comprised two, some comprise three candles. So we have things like three white soldiers, three red crows, you know, three story, three this, two that. We have haramis, dojis. We have bullish engulfing, bearish engulfing. We have tweezers. Okay. But the fact is, computers have made our life easy, because I can tell my charts to just tell me when there's a candlestick pattern that's developed. So all I do is I go up to my indicators and I go into my candlestick patterns and tell it, what candlesticks do I want to see when they appear on the charts? And all of these are different candlestick patterns. Well, I don't want to waste my time. I don't use the dragonfly doji. And bullish engulfing and bearish engulfing to me are significant candles. They tell you when the pattern's about to reverse, and they're fairly reliable. They don't tell you to make a trade, they just let you know what's happening. Then falling three methods, falling windows. Okay, anytime you have a combination of three different candles, they are fairly reliable, because it took three candles to develop. Okay, but things like harami, I like to see them because I like the name harami. But most of these I don't care about. Okay. So today, all I have to do is put the ones that I care about, click on them, and look at that. They appear on my charts right where it developed. So right here, I have a bullish engulfing. Well, I don't need to memorize what bullish engulfing is, because look at what my computers tell me. At the end of a given uptrend, a reversal pattern will most likely appear. During the first day, this candlestick pattern usually has a small body, is then followed, and not necessarily daily, this time frame to the next time frame. It is then followed by a candle where the candle body fully overtakes the body from the previous close. So in other words, this red candle fully enclosed the previous candle in the opposite color. So that told us that up move was moving. It was technically ending. Okay, it wasn't much of an up move. But like here, I have tweezers. So you can pick and choose what candlestick patterns are important to you, and tell your charts just to put them on, let you know when they're appearing on the charts. You can even set up alerts to let you know when a pattern's developed, because seeing a tweezer back here, a bullish engulfing here, a bullish doesn't help us much because we can only trade right here. So we need to know what is happening here and forward, because we can only make trades at the wall, and we only make profit in the future. But we need to see what is happening here. Now, so we've jumped past patterns. Okay. Now, I went a little bit too fast in class because we have to discuss a couple things, because I don't expect everybody to know off the top of the bat. Okay. And since this is a reading, writing, and arithmetic class, we need to start somewhere sensible. Now, a candlestick, let's get a nice one here. This one is made up of 4 pieces of information. Now, we're looking at a 30-minute chart because that's what I teach from. This candlestick has a line across at the open of the trading period, another line across at the close of the trading period. If during that period we climbed up the ladder from the open to the close, so in other words, the open was down here, close was up there, we would fill that in with green. We also put a dot at the high and the low, and we attach those dots to this body of the candle. These are sometimes called wicks or shadows. And today we use red and green. It's the most popular. When I started trading, it was all black and white candles because we were sitting in the pits, hand charting on graph paper. And if you're watching 4 or 5 assets, now granted the markets move slower, but we had no computers, we had no internet. We sat there with graph paper. So if you're following 4 different assets in different time frames, and you're following orange juice for June, orange juice for August, orange juice for September, and the prices are coming out through ticker tape, you're putting all those on your charts, and you happen to put them on relatively quickly, okay? Because you don't have time just to draw these lines. So in those days, we were using pencils and graph paper. So we would put a dash at the open, at the close, and say it was a negative period. The close was lower than the open. We put a dash across there. We would then go find what the high was that it reached, and we would then go find the low that it reached. We would then make the body of the candle. Now, if the candle was a bearish period, in other words, the price declined from the open to the close, you climb down the ladder, we would use the side of the pencil and color it in. And that candle was known as a black candle because it was the side of your lead pencil. If the opposite had happened, we had climbed up from the open to the close, we would just leave the candle alone. We would leave the outline there, and that became known as the white candle. So that was the difference between the black and the white. Black was bearish, white was bullish. Today, this has been replaced with greens and reds. But the fact remains, some brokers, their automatic default for their candlestick charts are their brand colors. Because as long as you know which color denotes bullish and which color denotes bearish, it doesn't make a difference. So if we wanted to change this right now to blue and orange, because those are my favorite colors, I could change my chart to blue and orange as long as I knew which one was bearish and which one was bullish. but most of us use the green or red. So we have the body of the candle and the wicks. Now, the wicks are very, very important, and so is the body. Because if you notice on this chart, we have all different shaped bodies. And those bodies tell us something. First of all, each candle tells us about the battle between the bears and the bulls and who won that battle in that time frame. So right now we're looking at a 1 hour chart, 30-minute chart. I could change it to a 1 hour chart, but we still tell the same story, use the same things. But this 1 hour chart tells us who won that battle. Okay. Now I explain candlesticks as, if you all think back, and maybe you're not old enough to remember, a little game we used to play when I was a kid on picnics called tug of war. And sometimes when we were camping and picnicking, there was a stream involved, and the guys would take one side and the girls would take the other, or this team would take one side and this team. And there was this constant battle back and forth. And sometimes the guys on the right would make a headway and a couple would fall into the lake on the left side, and then the other side would build its momentum and pull it back. And it would go back and forth. But how far back the team on the left was able to pull, and how short the team on the right was, and when the team on the right pulled as hard as they could, they weren't able to get much farther than where they were. This gives us the wicks, because ultimately, even though we had an open and a close, which is important, the wicks also tell us a great deal about the battle. So what can I tell you here about this battle? First thing I see is we have a red candle or a bearish candle. That means it opened here and closed down here. And what do we see here? We see no top wick. That tells us that the price, the bulls, were never able to gain any mustard in this trading session at all. They weren't even able to make a high. It opened here and it fell all the way down to this far. Now the bears were running and the bulls were really weak, but the bears, even though they yanked really hard and pulled it down, and weren't able to sustain back here, and the bulls were able at some time to gain enough momentum to pull it back up here, but they were so weak that it still was a red candle. So that tells you a story about what is happening at that moment. Combining that with the previous candle that was green, we say, do we have an uptrend moving here? We had been in an uptrend, doesn't have the momentum. Something tell me here, we have a little bit of a problem right here, because the bears should have never been this strong. So we're just telling a story by looking at the bodies and the wicks. Now, these small bodies also tell us a great deal. They're known as dojis. And when I first started trading, the rule of a doji was the open and the close had to be the same. Therefore, you would just have a line across, because there was no room for any body in between. Well, that's been adjusted ever so slightly, because in the old days, and these were old days, the markets moved very slow. And since we didn't have computers, stocks didn't trade at 142.579. You weren't trading currencies 4 digits or 5 digits now to the right. And because we've gotten so precise and with our computers and all of this, involved complicated trading, and the markets move so fast, well, it's very hard to say the euro opened at 119,957. And is it going to close at 119,957? 11957. 4 digits to the right. No, it might change, close at 119.56. Well, it's not even a pip. It's an insignificant fraction. So where do we draw the line? So doji is now defined as the open and the close are virtually the same. And that's why you have these small bodied candles that make up what's known as a doji. But here, look at that. We actually have a true doji there. Open and close are exactly the same. There's no body. And what that tells us is there's a huge amount of indecision in the market because the bears not only weren't able to make headway, made no effort to make any headway, and the bulls made no headway. So it opened and closed virtually the same. Now, we do have sometimes dojis with long wicks up and down, sometimes dojis with long wicks just up. And that helps tell you another story about the market. Because what you're trying to do with candlesticks is read the story of the markets. Okay, you're not trying to memorize patterns. You're trying to read what price is trying to tell you about what is going on in the marketplace. So let's go. So far we've looked at how a candle is built. We've talked about pattern recognition, and we've talked about reading price action in candles. So we've covered a lot of stuff relatively quickly because that's the easy part of candles. So you have to keep in mind that the what, which is price action, is more important than the why. All information that is happening in the marketplace, whether it's fundamental news, headlines, economic event, all is reflected in the price. And buyers and sellers move markets based on expectations and emotions. Markets fluctuate, and the actual price may not reflect the underlying value. But all of this is explained to you in each candle. By looking at the candle, you don't need to know that it was a very good jobs report last week. When that jobs report came out and the U.S. created 916,000 jobs, way more than was expected, you could have seen that in the next candle because, all the assets using like gold went down. The dollar, anything across the dollar got very strong. You could see exactly, couldn't see there was 916,000 jobs, but you could see in the candles on the chart that the report was extremely good. So we've already talked about what makes up a candle. We've talked already about what does the size and the shape of the candle tell you. So remember, when forex traders first start out, they usually learn about candlesticks, but what they learn is useless. They normally see a list of candlestick patterns, and each pattern has a set in stone definition, and that is the only meaning it can have. So we looked at charts. We saw hammers, inverted hammers, dojis. We saw bullish spinning tops. We saw shooting, and every one of those has an explanation like I popped up on that tells you what you're supposed to expect and what you're supposed to do when you see one of these patterns. I say hogwash. Because this is not candlestick analysis. It's memorization of pattern recognition. And for a price action trader, it's really useless. Sometimes it's worse than useless because thinking about candles as just patterns is counterproductive. It wastes your time. It gets you too complex, okay? And it can make you a worse trader. It leads you to massive mistakes. Why? Well, giving a pattern a set definition leads you to tunnel vision. When you see that specific pattern, you assume that something will happen. But that's not how candles work. All candlesticks need to be assessed based on the candlesticks around them and many other factors. Because the truth is, normally people say a spinning top means a reversal is imminent, which can be true. However, the same pattern can also mean that a continuation is imminent. It can mean that price is temporarily stalling. It can mean a lot of different things. So thinking of candles as simple patterns is the wrong way to do things. You need to look beyond the pattern and read the story of price. So what is the story of price? Every single candle on your chart is telling you a story. When you combine those candles together, you get the story of price. Reading and understanding the story of price is vital. It's vital because it allows you to answer one of the most important questions in trade. Who's in control of the market at that moment? Now, there's only three possible answers. There's the buyers, the sellers, or neither. And if you think when buyers are in control, price should be going up. When sellers are in control, price should be going down. When neither are in control, price is moving sideways. So would you want to buy something when the sellers are in control? So being able to accurately answer the question is vital. If you're about to enter a short trade and you ask yourself, who's in control of price? And the answer is buyers. Well, perhaps selling is not such a great idea. So let's break down the story of price. So let's start out looking at these three candles on my right. Okay, it's easy to conclude that the sellers are in control of price. That doesn't take a genius to see that, but it's not the truth. It's not who's in control. That's an assumption. Because the candles all closed lower than they opened. They all created new lows beyond the previous candle's low. And they all had upper wicks in comparison to the candlestick body. The small upper wicks indicate the buyers were unable to push the price up by much. But what does the highlighted candle in the next on the chart tell us that came next? So we had bearish candle, bearish candle, bearish candle. Telling you, if you just look at it, you assume, price is going down. Now, forget these candles. They don't exist yet because they're in the future. So, big red candle, big red candle, big red candle, little green candle. Okay. If I was looking at that, even though I saw a little green candle, I'd be looking for a sell position. I'd be wrong. So what does this little candle here that appeared next? It has a short upper wick, a small body, and a long lower wick. This is what we can call an indecision candle. Now, we get indecision candles all the time. Okay? It's not some revelation that never happens, and when it happens, some miracle is going to go on in the world. Nah. Indecision candles happen all the time. But how often do they appear after a strong move from the other direction? Okay. So you're telling the story of price. Price is falling, 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 and you get an indecision candle. An indecision candle is not just a small body. It's got a small upper wick, and it's the opposite color of the previous candle. So now you're telling a story about price. So what is this indecision candle? It's not a pattern. An indecision candle occurs when neither buyers or sellers can gain or maintain control of the price. They are common, but if used in the right way, they are very powerful. Any trading session, you'll see them all the time. They're not unusual. Okay. But they're also not a candlestick pattern. There is no definition or there's no pattern called an indecision candle. It's a small body. We're not saying how small the body has to be. It's a small bodied candle with a small upper wick in the opposite color of the previous candles after a strong move in one direction. Now, they appear, like I said, all the time. But when we combine that with the story of price that we're talking about, and the story of price isn't only candles. When we have our support and resistance on our charts, and if you don't know what your support and resistance levels are, that's another whole class that we have. But you have to always know support and resistance and trend lines are the basics of any charting. You need to understand them entirely before you even ever start reading candlesticks, before you ever start trading. But let's go back over to my live chart. Now you see all of these lines on my chart? There's gold ones, red dotted ones, blue ones. Those are lines of support and resistance brought from way back in history. Now, we're not going to get into my color coding because that's my own personal key. Okay. You have to have your own personal key. But because support and resistance lines come from the past and they're historic levels that you see on your charts whenever the asset was trading at this price, whenever it visited this price level in the past, whether 6 months ago, a year ago, 2 years ago. And I put my lines on there and they, your lines just go forward forever on your chart. So whenever price reaches that price range again, you see those lines. Now, let's not get involved in my personal color coding, my personal legend. When you get an indecision candle that falls on or near your level of support or resistance, okay, now I'm just going to stop this real quick. If you notice, while we were just talking, we got the TT pop up here. This is a tweezer's top. Okay. This is when two candles have highs or lows that are equal distance from each other and they look like a pair of tweezers. So we also have a doji and it's a tweezer top because look at the two highs are exactly the same. Well, that's telling us something about this price move right now. Okay. And we didn't have to do anything. These popped up on our charts while we were talking. Now, an indecision candle, see, that doji are both indecision candles. This doji is also an indecision. This small body candle is also an indecision. This small body is, but so is this one that's not such a small body. So they appear quite often. But when they appear on our level of support or resistance after a strong move in the opposite direction, they become significant because they tell us the market is about to reverse or that the move underfoot has lost its momentum. So let's go back here. So when we have our levels of support and resistance on our charts and the indecision candle develops right on our level of support or resistance, it becomes a lot more significant than just appearing after a move. So when price hits resistance, we get an indecision candle forming. So let's break down that candle into the story so you understand why it indicates indecision. It has a large, in this case, price was moving up instead of down. Okay. So instead of having a small lower wick, upper wick, it has a long upper wick because you got to flip it over the opposite direction of what we saw. So now we have a red candle after a run of green candles, and it's got a short downward wick, lower wick, and a long upward wick, and it appeared directly on our level of support or resistance. So it has a large upper wick that shows the buyers tried to continue the bullish trend but failed. Sellers took control of the price and pushed it down. So we saw the buyers kept their momentum, was able to push it up to this new high, but they couldn't hold on to it. And the tug of war existed, and the other side was able to pull it back. And when it was time, at the end of the day to have lunch and everybody let go, the rope was pulled farther over onto the guys on the right-hand side. So the sellers were in control. So we have indecision, but we saw that the bulls tried to continue and had the opening momentum. Because see, after a run up like this, the bulls should have momentum anyway. And they had momentum. They pushed it up, but they couldn't hold on to it. Their momentum died out. And it happened to die right on that level of resistance. So we have a small bearish body. and the small bearish body shows that the sellers were able to close lower than the open. This is significant because in all three candles before, the price consistently closed higher than open. This shows us that the buyers are losing their power. We had a small lower wick. The small lower wick shows us that the sellers were not able to gain much ground either. And this tells us the sellers are not strong enough to turn price around completely. However, they are strong enough to stall further buyer movement. Now, altogether, this indecision candle forming right after strong bullish candle suggests that the power has shifted from a decidedly bullish market to an undecided market. Well, sellers are not in control, neither the buyers. So what have you now done is you've broken all of this move down and told a story of price, and that story of price has taken you all the way up to the last time frame. So now you have interpreted what the market's telling you, and because you can only trade that way. Now, unfortunately, we could spend forever talking about candlesticks. We can talk about all different types of strategies. But there are many, many types of strategies. We have an entire 1-hour class in just trading the indecision candle and the indecision candle strategy. But their price action allows you to take many different types of trades, reversals, continuations, range swing, and breakouts, just to name a few. So you could look for a reversal trade. The one we were talking about. Reversals occur quite often. Reversals come in three parts: the preceding trend, the indecision candles, and the reversal trend. But what I'm talking about is we've used candlesticks without memorizing any patterns to read the story of price, to begin to make a decision to understand who's controlling the market, and to find a setup for where we might consider entering a trade. So we look at the preceding trend, the indecision candle, the reversal trend. Okay. And this happens very rarely. If you combine that with volume, okay, we could have a great decision-making capability, because when that price, that indecision candle, forms directly on that support or resistance level, depending on whether it's bearish or bullish, and we see a jump in volume, we can then use that information to make a trade. So indecision is one way to find a trading opportunity. But there are many different setups that we can use. But it will help us understand how to enter a trade, how to put our stop losses, okay, and how to get in at the right time. So remember, in this case, we have the preceding trend, the indecision candle, and the reversal trend. But we're just reading what price is trying to tell us on our price chart. So on that note, I'm going to say goodnight to everybody, and then join us for our indecision candle trading strategy in one of our upcoming classes. Or go look for it on our YouTube channel, and you can watch the recorded version of it there. So thank you very much, and have a great trading day. I hope you learned a little bit tonight. Bye now.